If you don't know what you're doing, it's a jungle out there.
Okay, let's take a look at the balance sheet of a published account and understand the jargon that is used there. Basically, they are all the same. We have asset, liabilities. Asset is what you own, liability what the business owns. Asset minus liability equals what is worth. Before you start the business, the company, before you is worth a certain amount of money. At the end of the business period, now the business is worth a different amount. So it's either your business is worth more or it's worth less. Similarly with your own personal finance, you have a balance sheet. You know exactly, take out everything that you own minus all that you owe. You have a net worth at a certain period. Like for example, now, how much do you want to be your net worth to be at the time you want to retire? That is, again, the asset and liability at the time, at a specific point in time. Now, in the published account, you will see here current asset, current liability. They are assets and liability which can be converted into cash within 1 year or less. Anything that is liquid. Then you have long-term investment. Then you have fixed asset. Here you have long-term liability and equity. This is other people's money. This is your own money. In the current asset, you have cash and short-term. These are cash already in the bank. Short-term assets are like fixed deposit or anything that can be converted into cash very easily within a year or less. In fact, these two are cash or cash equivalent. Now, receivable, accounts receivable are customers or customers who have owed you. You have sold them. They are, in other words, debtors. Prepaid expenses are like expenses that you have bought. Like for example, insurance. You bought insurance. You paid for it for the whole year. But you have not used it up. Therefore, it comes in here as a prepaid expense. Or stationeries you have bought, but you have not used it. It comes in as a prepaid expense. Right? In here. In fact, these two, if you take them together, they are basically that talk. The last item here is stock. It's how much you have bought but you have not yet sold. So if you look at this, these are three basic elements of business. Current asset is basically the three elements of business. What is it? Cash, customer, and product. If any of these elements are missing, there's no business. Customer wants product, business owner wants cash. In the long-term investment, what are you invested? Either in real estate or in share in businesses. This is what you bought, but it is not for the operation of company. These are investment that will generate income for your business. Fixed asset, on the other hand, are like for example building. Buildings are real estate bought by the company for the use of the business. You have plant and equipment and vehicle which are used for the purpose of running the business. So on here you have current asset, long-term investment, and fixed asset. This gives you your total asset. And where did we get the financing from this? It comes from the owner, which is proportionate capital. Or if the owner doesn't have the money, he goes to the bank and get a long-term debt, a 20-year loan. This is long-term debt. Current liability, you have accounts receivable, which is the same as, almost similar to the opposite side of accounts receivable. Now you bought stock. You haven't paid yet. This is your creditor. Accrued expenses are expenses which you are owing. Goods have come in, you haven't paid yet, therefore it is accrued. Owing. In other, these two are actually suppliers. On here you have debtors. This side you now have suppliers. What is short-term debt? Short-term debt, unlike long-term debt, are like bank overdraft. Bank overdraft comes in here. Short-term, that we must pay back within a year or less. What are long-term debt due? This long-term debt need to be paid over a period of 20 years. Anything that is due within 1 year can be current liability. Anything that is due within 1 year can be transferred, so that you know that what is need to be paid within 1 year needs to be paid more than 1 year. Here is financed by the owner. And if you look at the way of financing, it's either from the owner or from other people. So financing is basically money that comes into the company, comes in either from the owner or OPM, other people's money. If you don't have your own money, you have to learn how to use other people's money to make money. Is liability good or bad? Liability is only a source of finance. How you use it? If you take the money, there is always a cost. The cost of using capital is what we call dividend. The cost of using loan is interest. Creditor, supplier normally don't charge you interest. These are free blood supply, free source of finance. And one of the biggest free source of finance is your employee. They are your creditor. They come and work for you. They supply labor to you. You pay them 2 weeks later or 1 month later. They come in here as accounts payable or creditor. So, quickly to summarize, liability is a source of finance. Asset is how you use this finance, called application of the funds that has come